Pull up your last bank statement and look at the money that left. Federal tax withholding, Social Security tax withholding, property tax, Medicare premiums, tax preparation fees. Now understand this. Some retirees are paying these bills in 2026 because they truly owe them. But many are paying them because they never claimed the rule that could reduce them, stop them, or challenge them. That is the trap. The bill looks official, so they pay it. The county sends the notice, so they pay it. Medicare takes the premium from the Social Security check, so they accept it. A tax office charges $300 for a simple return, so they hand over the card. And every year, the same thing happens again. Money leaves. Nobody explains why. Nobody checks whether the senior still qualifies. Nobody says, wait, you may not have to pay this, because the people collecting the money are not paid to stop collecting it. That job falls on you. And that is exactly where retirees lose. Not because they are careless, because they trust the bill more than they trust the exemption. That is a costly mistake. Being eligible for a senior break does not stop the bill. Being over 65 does not automatically lower your property tax. Having a lower income this year does not automatically remove a Medicare surcharge based on an older tax return. Owing zero federal tax does not automatically stop withholding from your check. Qualifying for free tax help does not stop a tax office from charging you. The rule can exist, the form can exist, the exemption can exist, and you can still pay the full bill if you never claim it. That is what this video is about. 5 bills retirees may be legally exempt from paying, reducing, appealing, or avoiding in 2026. Not theories, not vague senior discounts. Real bills, real forms, and real places where money leaves before seniors realize they had another option. And stay until the end, because after the 5 bills, there are 3 bonus moves for homeowners, investors, and retirees with IRA money. Those can be worth even more. But first, start with the bill most retirees are afraid to question. Federal tax being taken from money they may not actually owe tax on. Bill number 1 is federal income tax being taken from retirement money you may not actually owe tax on. This is where seniors get nervous. They see withholding coming out of Social Security. They see tax held back from a pension. They see money withheld from an IRA withdrawal. And they think, if they are taking it, I must owe it. No, that is not how this works. Withholding does not prove you owe. Withholding only proves money is being taken before the final tax return is calculated. That is the first mistake. Many retirees keep withholding the same amount year after year because they are afraid to touch it. They think changing the form will get them in trouble. They think a refund means the system worked. They think the government knows exactly what they owe before the year is even finished. It does not. Your real tax is calculated after the year closes, after your Social Security is counted, after your pension is counted, after your IRA withdrawals are counted, after your deductions are applied. And for many seniors, those deductions are bigger than they realize. For tax year 2026, the standard deduction is $32,200 for married couples filing jointly. For single filers, it is $16,100. And seniors may have even more deduction room on top of that. There is the existing extra standard deduction for people age 65 and older. And now there's also the enhanced senior deduction. For tax years 2025 through 2028, many taxpayers age 65 or older may qualify for an additional $6,000 per person. A married couple where both spouses qualify may be looking at $12,000 before the phase-out rules start to matter. That is not a small number. That can change the entire return. A retiree living mostly on Social Security with a small pension may be withholding federal tax every month out of fear. Then tax season comes. The deductions wipe out the taxable income. The refund shows up, and the retiree feels relieved. But that refund was not a gift. It was their own money coming back late. Money they could have used during the year for groceries, insurance, medicine, property tax, or repairs. This is why bill number 1 matters. The bill may not arrive as a bill. It may be hidden inside withholding. A little from Social Security, a little from the pension, a little from IRA money, every month, quietly. The fix is not to stop withholding blindly. That would be stupid. The fix is to check the actual numbers. Look at last year's return. Look at this year's income. Look at your deductions. Then ask whether the withholding still matches what you will actually owe. If it does, fine, leave it alone. But if you are over withholding because you are scared, that is not planning. That is giving the government an interest-free loan. For pension and IRA payments, Form W-4P is used to adjust federal withholding. For Social Security benefits, Form W-4V can be used to request withholding or change it. Do not guess. Do not copy last year by habit. Check it. Because the first bill many retirees can reduce is not always a bill they write. It is money being taken before they realize they may not owe that much in the first place. And the next bill is even more misunderstood, because it involves Social Security itself. Bill number 2 is federal tax being taken from your Social Security check. And this one fools retirees because it does not feel like a bill. You do not open an envelope, you do not write a check, you do not swipe a card. The money's gone before you ever see it. That makes it easy to ignore. A retiree signs up for Social Security. Someone tells them, you might owe tax, so have some withheld just to be safe. So they file the form, 10%, 12%, maybe more. Then every month their Social Security check arrives smaller, and after a while they stop questioning it. That is the mistake. Social Security is not always taxed, and it is not always tax-free either. The answer depends on your other income. The IRS looks at a number built from half of your Social Security plus your other income, including tax-exempt interest. That number decides whether part of your benefit becomes taxable. For a single filer, once that number goes above $25,000, part of Social Security can become taxable. Above $34,000, up to 85% of benefits may be included in taxable income. For married couples filing jointly, the key numbers are $32,000 and $44,000. Listen carefully. This does not mean the IRS takes 85% of your Social Security. That is not what the rule says. It means up to 85% of the benefit can be counted as taxable income. Big difference. But here is where retirees overpay. They set withholding years ago. Then their life changes. Income drops. A spouse passes. Work stops. IRA withdrawals change. Deductions increase. The senior deduction changes the return. But the withholding keeps going. Same percentage, same monthly bite, same quiet overpayment. And the retiree thinks the refund at tax time means they won. No. A refund means the government held too much of your money during the year. That money could have paid for prescriptions, utilities, insurance, groceries, or a property tax bill. Instead, it sat with the Treasury for months. The fix is not to stop withholding blindly. Do not do that. The fix is to check whether the withholding matches your real tax. Look at last year's return. Look at how much of your Social Security was actually taxable. Look at your other income for this year. Then decide if the amount being withheld still makes sense. If too much is being taken, you can file a new Form W-4V and adjust the withholding or stop it if your numbers support that. But do not leave it alone just because it has always been there. That is how small monthly deductions become a silent bill. Bill number 2 is not Social Security itself. It is tax being taken from Social Security when the final return may not require that much. And before we move to bill number 3, I want you to answer one quick question. Before we move to bill number 3, answer this. Have you ever had tax withheld from Social Security, a pension, or an IRA just because you were afraid not to? Comment withheld if you have. I want to see how many retirees are letting money leave first, then waiting months to get it back. And if this video is helping you question bills instead of blindly paying them, hit the like button. That tells YouTube to show this to more seniors before they overpay. Now, bill number 3 is completely different. This is not money withheld from a check. This is the bill that hits homeowners directly. And in some counties, seniors keep paying the full amount for years because nobody told them the freeze or exemption had to be claimed. Bill number 3 is property tax. And this is the one that makes homeowners angry. Because this bill does not care that you are retired. It does not care that your income went down. It does not care that the house is paid off. It does not care that you have lived there for 30 years. The county sends the bill. And if you do not claim the senior relief, the full bill can keep coming. That is how this trap works. A senior turns 65. The county has the property record. The county has the mailing address. The county may even know the homeowner's age from past filings. But that does not mean the exemption appears automatically. That does not mean the freeze gets applied. That does not mean your bill drops just because you qualified. In many places, you have to file. And if you miss the deadline, you may pay the full amount for that year. No warning. No refund just because you did not know. No county employee calling you and saying you forgot to save money. That is not how property tax works. There are usually 3 kinds of senior property tax relief you need to ask about. First, a senior homestead exemption. This can remove part of your home's value from the taxable amount, not the market value, the taxable value. That difference matters. If your home is assessed at one number, but the county only taxes part of it after exemptions, your bill can drop. Second, a property tax freeze. This is the one many comfortable retirees miss. They assume help is only for low-income seniors. Not always. Some programs freeze part of the tax bill or assessed value once the homeowner reaches a certain age. That means your home value may rise, your neighborhood may get more expensive, the county may reassess nearby homes, but your protected amount may not rise the same way. That can save money every year you stay in the home. Third, a circuit breaker, credit, deferral, or postponement program. These usually help seniors whose property tax bill is too heavy compared to their income. Some programs reduce the bill. Some create a credit. Some allow the tax to be delayed until the home is sold or the estate settles. That last one is not free money. A deferral usually has rules. It may become a lien. It may have to be paid later. But for some seniors, it can stop a property tax bill from forcing them out of a home too early. Here's the mistake. Retirees hear one rule and assume it applies everywhere. It does not. Property tax is local. Your state matters, your county matters, your city matters, your school district can matter, your age matters, your income may matter, whether the home is your primary residence matters, and the deadline matters more than seniors realize. A neighbor across the street may pay less than you on a similar home because they filed the form and you did not. Same street, same age, same kind of house, different bill. Why? Because one person claimed the exemption, the other kept paying. That is the part that should bother you. Not every senior qualifies for every program, but every senior homeowner should check. Do not rely on a neighbor's answer. Do not rely on a random post online. And do not assume your tax preparer handles it, because property tax relief is often handled through the county assessor, not your federal tax return. Call your county assessor and use these exact words. I am over 65. What senior property tax exemptions, freezes, credits, deferrals, or circuit breaker programs are available for my home? Then ask the second question. Which ones have no income limit? Then ask the third. What is the filing deadline? Then ask the fourth. Do I have to renew this every year? Write the answers down, because one missed form can cost more than the form ever would have. Bill number 3 is not just property tax. It is property tax you kept paying because nobody forced the county to apply the break. And bill number 4 is even more hidden because it may not arrive as a paper bill at all. It may be taken out of your Medicare or Social Security before you even notice it. Bill number 4 is Medicare. And this one is dangerous because it does not always feel like a bill. Sometimes it is not sitting in your mailbox. Sometimes it is not something you write a check for. Sometimes it is taken before the money ever reaches you. A smaller Social Security deposit shows up. You assume Medicare took what Medicare was supposed to take, and you move on. That is how overpayments hide. There are 2 Medicare charges retirees need to check. The first one is Medicare Part A. Part A is hospital insurance. For most people, the monthly premium should be 0, not reduced, not discounted, 0. That usually happens because you or your spouse worked long enough and paid Medicare taxes long enough. The common number is 40 quarters, 10 years. But some retirees still end up confused. A work record may not be matched correctly. A spouse's work history may not be considered. A person may think they have to pay because they personally did not work enough, even though a spouse's record could matter. So if you're paying a monthly premium for Medicare Part A, do not just accept it. Check it. Ask Social Security whether you qualify for premium-free Part A based on your own work record or a spouse's work record. Because if the correct premium is 0, every monthly payment above 0 is money leaving for the wrong reason. The second Medicare overpayment is the one that hits higher income retirees. It is called IRMA, Income-Related Monthly Adjustment Amount. The name sounds harmless. The charge is not. IRMA is an extra amount added to Medicare Part B and Part D when your income is above certain levels. And here's the trap. Medicare is usually not looking at your income right now. It is often looking at your tax return from 2 years ago. So a retiree can stop working. Income drops, paychecks disappear, the retirement year begins. But Medicare may still charge a higher premium based on the old high income year. That is where seniors lose money. They see the surcharge. They assume it is permanent. They assume Medicare knows their income dropped. They assume there's nothing to do. Wrong. There may be something to do. If your income went down because of a qualifying life-changing event, you may be able to ask Social Security to review the IRMA charge. The form is SSA 44. That form is not magic. It does not erase every surcharge. It does not apply to every situation. But if you retired, reduced work, lost a spouse, divorced, lost pension income, or had another qualifying event, it can matter. This is the kind of form many retirees never hear about until they have already paid the higher premium for months. That is the expensive part. Medicare does not always overcharge you with a dramatic warning. It just takes a little more, month after month. And because it comes out of Social Security, many retirees do not feel the hit the same way they would feel a paper bill. But it is still money. So check 2 things. First, if you're paying for Part A, ask why. Do not assume. Second, if you received an RMA notice or your Medicare premium jumped after retirement, check whether the income they used still matches your life today. If it does, fine. Pay what you owe. But if Medicare is using an old income year that no longer represents your situation, do not sit there angry. File the review. Ask the question. Make them look again. Bill number 4 is not just a Medicare premium. It is a Medicare premium that may be based on an old record, an old income year, or a rule nobody explained before the money started leaving your check. Before we move to Bill number 5, subscribe if you want retirement rules explained before they become expensive. Because most seniors do not lose money from one big mistake. They lose it from small rules they were never told to check. A Medicare surcharge, a property tax exemption, a withholding form, a free tax program, one missed rule at a time. So if this is helping you catch those rules before the money leaves, subscribe now. Now Bill number 5 is different. It is not tax withheld from a check. It is not a Medicare charge. It is the fee many retirees pay just to file a return they may qualify to get prepared for free. Bill number 5 is the tax preparation fee. And this one does not look like a government bill. That is why people miss it. Every year, seniors walk into a tax office with a simple retirement return and pay $200, $300, sometimes more, for a return that may only include Social Security, a pension, a 1099-R, bank interest, and maybe a brokerage statement. Now listen carefully. If your return is complicated, pay a qualified professional. If you sold a business, own rental property, have a complex trust, have large capital gains, or need real tax planning, paying for professional help can be the smartest money you spend. This bill is not about that person. This is about the senior with a basic return who keeps paying because they think paying is the only serious option. It is not. The IRS has a program called Tax Counseling for the Elderly, or TCE. It offers free tax help for people age 60 or older, and it focuses on issues seniors actually deal with: pensions, Social Security, retirement account withdrawals, and basic retirement tax questions. That matters because a senior return is not the same as a 22-year-old filing one W-2. A retiree may need someone who understands Social Security taxation, pension income, IRA forms, and senior deductions. That is exactly why this program exists. A major provider is AARP Foundation Tax Aid. And no, you do not have to be an AARP member just to use the service. That one misunderstanding alone keeps people paying fees they may not need to pay. There are also IRS free filing options for people who qualify and are comfortable filing online. But the in-person help is what many seniors should check first, especially if they do not like tax software. Here is the catch. Free does not mean unlimited. These programs are not built for every complex situation. They may not handle everything. Some sites fill up fast. Some only operate during tax season. Some require appointments. Some may turn away returns that are outside their scope. So do not wait until the last week before filing. Search for TCE tax help near you. Search for AARP tax aid near you. Call early. Ask what documents to bring. Ask whether your type of return is covered. Because paying for expert help when you need it is smart. But paying a chain tax office hundreds of dollars for a simple return while an IRS-supported senior program was available nearby is different. That is not caution. That is a fee you may have been able to avoid. Bill number 5 is the tax prep fee. And for many retirees, it is the easiest bill on this list to check before tax season ends. Now the 5 bills are covered, but do not leave yet. Because the next 3 moves can be bigger than the bills. The first 5 were about money seniors may be paying right now. Tax being withheld, Social Security being reduced, property tax being overpaid, Medicare premiums being pulled, and tax prep fees being charged. But these next 3 are different. These are not small monthly leaks. These can affect one-time decisions worth tens of thousands of dollars. Selling a home, selling investments, giving money to charity from the wrong account. If you do not own a home, do not have investments, and do not have IRA money, the first 5 bills may be the main part for you. But if you have built anything over your lifetime, stay with me. Because the next mistake is one of the reasons some retirees stay trapped in the wrong house for years, not because they want to, because they are afraid of a tax bill that may not even exist. Bonus move number 1 is the home sale exclusion. This is not a monthly bill, but it can control one of the biggest financial decisions a retiree ever makes. Selling the house, downsizing, moving closer to family, leaving a home that became too expensive, too large, or too hard to maintain. And I have seen retirees stay stuck in the wrong house because of one fear: taxes. They bought the home decades ago, the value went up, the neighborhood changed, the house is worth far more than they paid. So they assume selling means the IRS is waiting at the door. That fear can freeze people. They keep paying for repairs, they keep paying insurance, they keep paying utilities on rooms they do not use. They keep climbing stairs they should not be climbing. All because they are afraid of a tax bill that may not even exist. Here's the rule. If you sell your main home and qualify, you may be able to exclude up to $250,000 of gain if you're single, and up to $500,000 of gain if you are married filing jointly, not sale price, gain, that matters. If you bought the home for $150,000 and sell it for $400,000, your gain is not $400,000. The gain starts with the difference between what you sold it for and your adjusted basis. Improvements can matter. Selling costs can matter. Records can matter. That is why you do not guess, but the basic rule can be powerful. For many retirees, the exclusion covers all or most of the gain. That means the federal tax bill they feared may be zero, not because they found a loophole, because the law already allows it when the rules are met. The common test is simple. Did you own the home for at least 2 of the last 5 years? Did you live in it as your main home for at least 2 of the last 5 years? Did you avoid using the exclusion on another home sale too recently? If yes, you may be in range, but do not assume. Check before you list, because this rule can work both ways. Some retirees are scared of a tax bill they may not owe. Others assume the exclusion covers everything, then discover their gain is larger than the limit. Both mistakes are expensive. So before you sell, ask one question. How much of my gain is actually taxable after the home sale exclusion? Not how much the house sells for, not how much cash shows up at closing. The gain, that is the number that matters. Bonus move. Number 1 is not telling every retiree to sell. It is telling you not to stay trapped because of a tax fear you never checked. And the next bonus move is similar, because some retirees are afraid to sell investments when the federal tax rate may be 0. Bonus move number 2 is the 0% capital gains window. This one surprises retirees because it sounds impossible. They hear capital gains and assume tax. They sell stock. They sell a mutual fund. They sell an ETF. They sell something in a regular brokerage account that went up in value. And they assume the IRS automatically gets a piece. Not always. There's a 0% federal long-term capital gains rate. That means if your taxable income is low enough, some long-term investment gains may be taxed at 0% federally. Not 15, not 20, 0. But the window depends on your taxable income. That is the part retirees miss. It is not based only on the size of the gain. It is based on where that gain lands on your tax return. For tax year 2026, the 0% long-term capital gains rate applies up to $49,450 of taxable income for single filers. For married couples filing jointly, it applies up to $98,900 of taxable income. Taxable income, not gross income, not total money coming into the house. Taxable income after deductions, that difference matters. A married retired couple could have Social Security, some pension income, some interest, and still have a lower taxable income after deductions than they think. That can create a window. And if they sell long-term investments inside that window, part of the gain may fall into the 0% federal capital gains bracket. Now here is where people make the mistake. They wait. They hold every investment because they are afraid of tax. Then later, required minimum distributions start. Income rises. The taxable income window gets smaller. Medicare thresholds get closer. Social Security taxation may increase. And the same investment sale that could have been handled at 0% earlier may land in a higher tax year later. Same stock, same gain, different year, different tax bill. That is why timing matters. The years right after retirement can be some of the most important planning years of your life. You may no longer have wages. RMDs may not have started yet. Your taxable income may be lower than it will be later. That is when smart retirees check whether capital gains can be harvested on purpose. Not randomly, not emotionally. Not because the market moved one day. On purpose, with a tax return in front of them. But be careful, this is not a license to sell everything. A large gain can push income higher. State taxes may still apply. Medicare IRMAA can still matter. And short-term gains do not get this same treatment. This is for long-term capital gains, generally assets held more than 1 year. So before you sell appreciated investments, ask the real question. If I sell this year, how much of the gain falls into the 0% federal bracket? Not, will I owe tax? That is too vague. Ask where the gain lands, because the same gain can be expensive in 1 year and nearly painless in another. Bonus, move number 2, is not about avoiding tax by accident. It is about not missing a legal 0% window because nobody told you to check before RMDs and other income fill the space. Bonus move number 3 is the qualified charitable distribution, a QCD. This is for retirees who are 70 and a half or older, give money to charity, and have money sitting in a traditional IRA. If that is you, listen closely, because many retirees are giving from the wrong account. They write checks from the bank, they give from the checking account, they swipe a card, they send money to the church, the food bank, the school, the hospital, or the charity they care about. Then later, they take money out of the IRA for living expenses. That IRA withdrawal shows up as income. It can raise adjusted gross income. It can affect Social Security taxation. It can affect Medicare income calculations. It can make a clean charitable habit create a dirty tax result. Now change the route. Instead of taking money from the checking account for charity, the retiree asks the IRA custodian to send money directly from the traditional IRA to the qualified charity, not to the retiree, not to the retiree's bank account, directly to the charity. That is the QCD route. Same charity, same gift, same heart. Different tax result. For 2026, the annual QCD limit is $111,000 per person. Most retirees will never use that full limit. They do not need to. Even a smaller QCD can matter if it keeps income off the return. $500, $2,000, $10,000. The power is not only in the size of the gift, the power is in the root, because a properly handled QCD can be excluded from taxable income, and once required minimum distributions begin, a QCD can also count toward that required amount. That means a retiree may be able to satisfy part of the forced IRA withdrawal by sending money directly to charity instead of taking it personally first. That is a very different result, but the rules matter. The money must generally move directly from the IRA trustee or custodian to the charity. If it lands in your bank account first, you may have ruined the treatment. If the check is made payable to you, you may have created a regular IRA distribution. If you try to send it to a donor-advised fund, that generally does not qualify, and you must be 70 and a half on the date of the distribution. Not almost, not later that year. On that date, that is where seniors make expensive mistakes. They hear the idea, they like it, then they move the money the wrong way. The charity still gets paid, but the tax result may be gone. So if you are over 70 and a half and already give to charity, ask your IRA custodian one question. How do I make a qualified charitable distribution directly to this charity? Do not guess. Do not transfer first and ask later. Ask before the money moves. Because in retirement, the same dollar can create two different tax results depending on the path it takes. And that is the theme of this entire video. Most retirees do not lose money because the rules do not exist. They lose money because nobody shows them where to claim the rule before the bill gets paid. So bring all of this together. 5 bills, 3 bonus moves, 1 lesson. The bill does not stop just because the rule exists. Federal tax withholding can keep coming out of retirement income, even when the final tax return may not require that much. Social Security tax withholding can keep shrinking the monthly check because a form was filled out years ago and never checked again. Property tax can keep hitting the full amount because the county does not automatically apply every senior exemption, freeze, credit, or deferral. Medicare premiums can keep pulling money from Social Security because of an old work record, an old income year, or an IRMA surcharge nobody challenged. Tax prep fees can keep coming every year, even when a senior may qualify for free IRS-supported tax help. Then the bonus moves. A home sale may not create the giant federal tax bill a retiree fears. A long-term investment sale may fit inside a 0% capital gains window if the year is planned correctly. And a charitable gift from the wrong account may create taxable income that could have been avoided with a QCD. Different bills, same trap. The rule is available, but nobody applies it until you ask. So here is what I want you to do next. Do not try to fix everything in one day. Start with the bills that are already taking money. First, check your federal withholding. Look at Social Security, pensions, and IRA payments. Ask if the amount being withheld still matches what you actually owe. Second, calculate whether your Social Security is really taxable. Do not guess. Look at the numbers. Third, call your county assessor and ask about senior property tax exemptions, freezes, credits, deferrals, and deadlines. Do not wait for the bill to arrive. Fourth, check your Medicare premium. If you're paying for Part A, ask why. If you received an IRMA surcharge after retirement or an income drop, ask whether Form SSA 44 applies. Fifth, before paying for tax prep again, search for TCE or AARP tax aid in your area. If your return is simple, check the free option before handing over money. Then, before any large move, slow down. Before selling a home, check the home sale exclusion. Before selling investments, check the 0% capital gains window. Before giving from your checking account, ask if a QCD makes more sense. That is the action plan. Not panic, not guessing, checking. Because the most expensive retirement bills are often the ones that look normal. They show up every year, they get paid every year, and nobody questions them until someone finally says, wait, do I actually owe this? Drop a comment and tell me which bill surprised you the most. Just write the number 1 through 5. And if this helped, send it to one person over 65. Because one missed exemption can cost more than a gift. One missed form can cost more than a dinner. And one senior learning this before the next bill arrives can keep money where it belongs, in their own account.